Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Chris Paniotu, certified financial planning professional, the Cap and Capitalize. And on today's episode, we are going to get into opportunities around lowering interest rates, potentially, of course. But before we do that, as always, our free advice for the day. Reassess, the number one place where you can guarantee your greatest returns, the taxes you potentially won't have to pay. So as of this episode, you are in the midst of tax season. Some of you may be already done with your tax returns, whether you did it by yourself or you worked with a tax professional. If you are done with your taxes, this is something I want you to do. And it's actually not as boring as you may think. I want you to actually read over your tax return and discuss with your tax preparer, assuming you have one, what you can do to better your situation for the following year. If you don't work with one and you did used a free service online, I want you to go through it and ask if you maxed out the deductions that you could have maxed out. Were you able to actually max out your retirement plan contribution? Were you able to contribute to an IRA or a Roth IRA? Were you able to take certain credits? 99% of the time, you can do better as opposed to the previous year. And really, if you can do better and you found something that you didn't do in 2024's tax season, don't get mad about it. Just take it as a learning opportunity and you will be forever glad that you did. So that's the free advice for the day. Now let's get into some strategies for you to possibly lower interest rates on your debts, as well as how interest rates will affect your overall financial situation based on certain investments. So there's a lot that we're going to go over. So you're going to have to buckle up for this one. So the first one we're going to talk about is one that compliance absolutely hates, but we got to talk about it, and it is refinancing options, okay? Now, mortgage refinancing was huge in recent years, especially during 2020 and 2021, when interest rates were at historically all-time lows. And there are a number of ways that you can tackle the concept of refinancing. So a lot of people, and let's just use a mortgage as an example. If you have a 30-year mortgage at a 5% interest rate and you've been plugging along the last couple of years, well, then what you can do is if interest rates drop, you can refinance. So instead of a 5% mortgage, maybe you have a new 30-year mortgage at whatever that balance is, which again, it's going to be lower. And that interest rate is, yes, instead of a 5%, maybe you go down to a 2.99 like I did in 2020, and a lot of people did. Or another way to think about it is all of that cash flow that you're freeing up. And then you take all of that extra free cash flow, and instead of putting that back into the mortgage at a 2.99% interest rate for the purpose of this this example, then you go and you reinvest that maybe into a 401k, Roth IRA, investment account, et cetera. And let's say you're going to earn 8% in the long run. Hypothetically speaking, again, compliance, don't kill me for that. So if you take 3% money, 2.99, but I'm rounding up, and then you earn 8%, that is capitalizing on the spread, pun intended. Yes, it's in my book. Yes, you're welcome. No, if you've not read it, shame on you, of earning an additional 5% on your money. So mortgage refinancing is obviously the most popular. There's actually something called recasting, where instead of taking out a new loan, it basically just recasts to a different interest rate, but then it's for the same, it's the same dollar amount that you have, but then it's just a shortened period of time. So if you took a 30-year mortgage out and then in 3 years you recast it, still 27 years, but it's at that new interest rate. So that can be an option, but it's not nearly as utilized as the traditional refinancing. And then there's also cash out refinancing, but frankly, from a compliance standpoint, I'm not supposed to talk about it. And frankly, as much as I bash compliance, that's one area where I don't just want them to delete the point of this episode. So I'm not going to talk about it. However, there are other places that you can refinance. You could refinance your car loan. You could refinance your student loan. You could refinance a personal loan. If you have some type of debt on your financial books, you should have the ability to refinance. Now, that doesn't mean you need to do that. So don't think, oh, I listen to the Cap and Capitalize and I've got a mortgage, I need to go refinance it. Absolutely not. But you need to be very cognizant of how, if interest rates increase or decrease, how refinancing can be instrumentally valuable for you. Now, when it comes to leveraging debt, and we talked about capitalizing the spread earlier, and by earlier, I mean like 30 seconds ago or a minute ago, but I need to stress with you how valuable that actually is. And I may just give you another example. So let's say that you have, a home and you have, the home is worth $500,000 and you have a mortgage left on it of $300,000 and that mortgage rate is 5% or 4%. Let's go 4%. Just bear with me here. But let's say you also have credit card debt and it has just been hammering you over the last couple years. You just can't claw out of it. Let's say it's like 30 grand. Ouch. And the interest rate is 27%. Double ouch. And you look at that and you go, oh my gosh, like how in the world am I going to be able to pay this out? Well, I can tell you, if you were able to cash out refinance, and let's just say you took a second mortgage with $30,000 of equity in your home, and that mortgage rate, maybe it's not 4%, maybe it's 5 or 6, 7, 8, doesn't really matter. That number is a hell of a lot lower than 27.99. So the value of leveraging that debt on that you would incur on your home is to go pay off that worse off debt of 27.99. And then that second mortgage, that monthly payment is going to be a heck of a lot less than that credit card debt. And that's another way that you can get ahead. Now, don't get obsessed with that. And particularly homeowners or condo owners, if you're listening to this, a lot of people get over leveraged, and which means you have too much debt. And that's where you get in a heck of a lot of trouble. But just know that that is an arrow in your quiver if you want to pull it and capitalize on leveraging debt. Now, another thing when it comes to debt is, and we talked about this when it comes to retirement side of things, you need to think about the rate of return that you think that you can confidently earn in the long run. And a lot of people do this. And by a lot of people, I mean like people in our industry, like super investors that I've interviewed, they all have that bogey number that they're trying to achieve. And that number is going to be higher than most people because these are professionals. And frankly, their track record shows they actually know what the heck they're talking about. But for ease of reference, and because I know a lot of people don't want to become super investors. And if you're listening to this, you just want to get ahead. And I get it. Let's just use the number of 6%. So if you have debts that are higher than 6%, you want to order it from highest debt interest rate to lowest interest rate. And you want to snowball anything above and beyond that you have extra into that high interest debt. Again, you want to max out your match with your 401k, but then anything above that, you want to hit that 27% credit card rate. And then you keep going down the list and keep snowballing and snowballing and snowballing until you get to debts that are below that bogey number, which in this case is 6%. Then what do? You take all of that extra cash flow and you just pump it into your retirement account, which could be Roth, tax-free. and maybe you're earning that net of tax return of 6% you think you can earn in the long run. Or if you're in a higher tax bracket or you want to pay less in tax, then you dump all of that money into your 401k pre-tax, and then you avoid all of those taxes with that extra cash flow that you have, which is really, really, really cool. And when you understand interest rates, that makes it a lot more complex, but also it makes it a whole heck of a lot more simple. And we'll talk about that later. Now, I want to reassess saving strategies before we get into the commercial break. And after this commercial break, I do want to tell you, you are going to have to buckle up because it is going to get importantly dicey in a fantastic way. But I don't want to tease it too much. So reassessing saving strategies. So I want to talk about the impact of lower interest rates on savings accounts in CDs or certificate deposits, for those of you that do not like abbreviations, where you go to a bank and you buy it, and then whenever you get that money back, that is the rate of return that you're going to get. So when interest rates decrease from a purely just black and white standpoint, interest rates affect savings accounts in the fact that you're earning less on the savings, and then CDs, you're going to earn less on those returns as well. Because generally speaking, and it's not this close, but it's close enough. Interest rates, CDs, savings rates, they all kind of mix together. So when you look at interest rates, that's kind of the engine to what is going to follow with all of those banking type of accounts. I want you to know that interest rates going up and down in and of itself doesn't really mean a whole heck of a lot. It does from an economic policy standpoint, from a planning standpoint. Do not overthink it. Just use interest rates as a tool for you to understand how your plan and investments and strategies within your plan will move and pivot and basically just relate to each other. Now, we talked about this a lot on the show, and I will repeat it again. If you do not have an online savings account for your money that you need to just set aside, and again, just to remind you, whatever you have in your checking account, that should be a month of expenses. So money in, money out, that's what you have in checking. And then generally 3 to 6 months in your savings, depending on your situation. If you have an online savings account right now, as of this recording, the average online savings account return is going to be anywhere from the 3.5% to the 4.5% range. So it's come down a little bit. However, that's a heck of a lot more than 0.05% that you're getting in these traditional banks. And we've talked about that in the past as to why these online savings accounts can do so. But that's really beside the point and beyond the scope of today's episode. Even if interest rates do drop and that interest rate drops, that's still going to be a really good thing for you to do. And then before we dive into the commercial break or jump into the commercial break and then dive back into the episode, I want you to know that some people try to get really hungry or for yield and return and all these different types of savings and strategies as far as savings accounts. Don't overthink it. Once you find one, keep it simple. Like my wife and I have our online savings account at Capital One. No, I'm not sponsored by them. Yes, it would be fantastic if the Cap and Capitalize was sponsored by Capital One, but that's beside the point. I know that there are other options out there, but for business reasons and just simplicity reasons, we have other tools and vehicles with them. So it just makes it really easy to be on their platform. Again, there could be an option where you could earn maybe 0.1 or 0.2% more, but this is money that's just sitting there anyway. So in the grand scheme of your financial life, you're pinching pennies, and don't be penny wise, pound foolish. That is a recipe for financial disaster. So we are going to take a quick break. And then when we come back, we're going to talk about a little bit about debt repayment, prioritization, economic trends, and most importantly, how every part of your plan as far as different investments work relative to interest rates going up or down. So stick around.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back to the show. I cannot wait to close this thing out with debt repayment prioritization and then talking about how interest rates affect every investment that you can possibly utilize within your capitalized financial plan. But before we do that last part, we got to talk about the debt repayment. And I want to talk about, should you pay off your debt faster or invest the difference? Now, right before the commercial break, we covered this. However, I want you to think about it in a leveled up way. So let's think about it from a business owner's perspective versus an everyday person. So let's say that you as a business owner, you've got debt on your books, you're growing, you're hustling, you're grinding, you're making it happen. But you have profit, and for the first time in your life, which is great, and you think to yourself, okay, what should I do? Should I go pay off that debt or should I go reinvest back into the business? So let's think about this for a second. So let's say that you have, and I don't really care what the number is. Let's say it's $100,000 and you reinvest it back into your company. Okay. And you're doing it for marketing and trying to build your brand, whatever. So if you make that money back in 3 years, so you get that $100,000 back in 3 years, you just earned 33% on your money. If you earned it in 4 years, 25%, 5 years, 20%. On top of that, when you reinvest that from the marketing or research and development side of things, in the year of which you spent all of that, you get to write all of that off in that year. So not only are you earning that absolute return when you actually get that money back as a result of your marketing and research and development, but you're also getting a tax deduction in that year because you write all that off in your expenses line on your income statement. Really, really valuable stuff. So why am I telling you this? Take that mentality and apply it to your everyday life. So if there is something that let's say you don't have a business and you're not a business owner, you're an everyday employee, which there is nothing wrong with that. And in many ways, I'm extremely jealous of you. But let's say that you love what you do, you're passionate about it, you've got an amazing career or job, and there's something that you know that you can do. Maybe it's a course, maybe it's a program, maybe it's a seminar that you go to, maybe it's a networking event or a mastermind community. There's something that you can reinvest into yourself, and it takes whatever the dollar amount is. And your only option is to take out a loan, a piece of debt, to go and pay for that thing. What I want you to do is I want you to think about, when are you going to get that money paid back? When do you think? What are the odds that you get that money paid back in that time? Because you got to have a margin of safety. It's no different than investing. And then ask yourself what that debt rate of return is. And then on top of that, you need to think, okay, when am I going to be able to pay this debt off and then have a net positive and actually profit on what it is that I'm taking out, the mastermind or whatever the case may be. So when you think of that, it's actually a pretty simple framework in your mind, just going through all those steps that I just rattled off. But I'm going to tell you, if you think of that from here on out, as far as utilizing debt to your advantage with interest rates and comparing that interest rate on your debt to the return that you're going to get when you get your money back in the amount of time, you are ahead of not only 99% of like your friends and family. I could argue you're ahead of like 95% of people in my own industry. Now, I'm not exaggerating with that. Okay. I'm actually being a little gracious. It could be even higher. So once you get that thought process, what's really cool is even though you are an employee, now you're thinking as an owner and you have actual financial understanding of the ownership of your life. Really, really cool stuff. Now, my most exciting part of this episode, I'm very excited to talk about this, economic trends, how lowering rates affect different types of investments out there. So let's go for, and it's really no particular order, but let's think of like long-term investments out there. So I've talked about this in the past, talked about this in my book. There's the stock market, there's private equity, there's private credit, so lending, floating rate loans, there's real estate, and you know what, we're just going to go with that for now, okay? Because those are probably the most commonly available to most people. So the stock market and private equity, regardless if it's publicly traded or privately traded, those are businesses. And with those businesses are going to go and take debt out to go reinvest in grow, in maximize profit for their business. Like, why wouldn't they? That is the point of businesses going up and to the right over time. So if interest rates are increasing, that's generally not great for businesses. But if they're lowering, that is fantastic for these businesses. Now, I'm not saying lowering interest rates are suddenly going to result in private equity businesses doing better and stock prices suddenly rising. A lot of people perceive that, and in many cases, there can be some causation with that, but that is immensely overblown because you got to actually look at the business. But in general, businesses love when interest rates drop. Real estate, it's the exact same thing. If you have a 5% mortgage on your commercial property, your warehouse, your multifamily apartment complex that you own, or just your home, and you can refinance because interest rates have dropped from a 5% to a 3%, not only did you save 2% by capitalizing on the spread, not only did you free up cash flow that you have every single month, but even if you did a cash out, and then you went and reinvested that in whatever strategy that you can further capitalize on the spread. There's a multitude of reasons why real estate and real estate investment professionals are frothing at the mouth when they hear that interest rates are dropping. Now, with private credit, that is where, generally speaking, assuming it's floating rate loans, that is where lowering interest rates are not necessarily the best thing since sliced bread. Because if interest rates drop, these floating rate loans, which are tied to whatever the interest rates are out there, the LIBOR rate, most commonly known, that's beside the point. If those are decreasing, you're not going to earn as much income on those. However, you shouldn't be ticked off about that, because if you have other investments like the real estate, private equity, stock market, these publicly traded businesses within your portfolio, they're going to make up for it. Okay, so private credit can actually be kind of a hedge of utilizing interest rate risk within a portfolio, which is ironic because private credit in and of itself is directly associated with interest rate risk, but it's neither here nor there. And I cannot stress this enough. I cannot stress this enough. Just because of what I said, if interest rates go up and down, it is not going to be an overnight thing with these investments. Generally, there is a lagging indicator. And then sometimes, even if interest rates did rise substantially, there have been times where companies in stocks, 2022, stock market was down 20%. We had stocks in our portfolio that were immensely affected by interest rate risk because they produce things. And in some cases, they were up like 40%. It really didn't make a lot of sense. But in the long run, generally speaking, interest rates in businesses, everything kind of catches up. But even with that, let's say you are in a rising interest rate environment and a company is growing their revenue and their profit at 30%. I mean, unless interest rates got to like 1982 levels, which if that's the case, we are buckle up because it's going to get gnarly. The point is, interest rate risk, that's not going to affect that business. It may affect like, oh, I can't take out as much money to go and reinvest that much more into the business. You're still growing at 30%. Like I'm not worried about that. Now, I also want to talk about now like how investments work in other investment strategies, not just those long-term investments that I mentioned just now. So generally speaking, if you have a type of an annuity, whether it's an income annuity or a fixed index annuity, equity index annuity, there's a lot of them out there. Generally speaking, when interest rates are rising, that is all in all much better for shorter term investments like annuities, CDs, bonds, online savings accounts, money market accounts. Now, when it comes to like intermediate types of monies in rates are increasing, that in theory can get a little bit more risky, in particular like preferred stock. So a preferred stock, just for you that are not aware, there's 3 layers to a publicly traded business, just to make it really easy. There's debt, which is the first people to get paid, preferred stock shareholders, and then common shareholders. And common shareholders are the like publicly traded stock that you commonly refer to as the stock market. So preferred shareholders, they are taking on more risk because they get paid after the debt, but they're not taking on as much risk as the common stock shareholders. And so they're getting paid a higher income. And I say that because let's say that you take out a preferred stock in 2019 or 2018 because interest rates were really, really low. Well, then you fast forward to today, and because interest rates are super, super high relative to back then, bonds, which are traditionally more conservative than preferred stocks, are actually paying almost, if not some cases, the same or more than preferred stocks that you could have utilized back in 2018 or 19. So you have to shift. You have to be nimble in the mind when it comes to that. But on the flip side, if interest rates keep dropping and dropping and dropping over the course of a couple of years, in preferred stocks, they generally just pay that same dividend over the 5-year period or however long you choose to keep it. That suddenly becomes more and more and more valuable because that interest rate it's becoming less and less and less and less of a possibility to get that rate of return. Now, for you, and you ask yourself, okay, if you're in your 20s or your 30s, or I could even argue your 40s, does interest rate risk have a bearing when it comes to your overall financial situation? Yes, but you also have to remind yourself, you got to just keep doing the damn thing. You got to keep saving. You got to keep investing. And there is a smidget of it if you are in tune with how all of this works, then you can start to get a little bit creative on like where you can go and put your next dollar for a long-term return to possibly add a return above and beyond what most people are going to earn. When you are retired, that changes the game a lot because from an interest rate standpoint, and you're using all of these tools, short-term and long-term and intermediate-term types of strategies within your plan, you've got to be very aware that interest rates moving up or down a decent amount. If it's just, kind of bumping around, it's not really going to move your needle. But if it's a decent amount, you've got to be very aware as to how your retirement plan actually changes and how different strategies may come into favor or out of favor. So my homework for you that are in that situation is to talk to your certified financial planner about that. And if he or she cannot answer that, or if they're answering some boilerplate crap that their compliance has got a gun to their head saying, this is what you need to say, you need to find someone else, period. But on the flip side, if they can actually explain that and then also articulate why your plan is or is not still in proper alignment with what you're trying to achieve, and then they are already proactive with other strategies that may or may not be a better option within your plan, then you've got yourself a winner. So that does it for opportunities around lowering interest rates. And again, there are risks out there when it comes to interest rate risk, whether they go higher or lower. But my hope is after you've listened to this episode, you know how to mitigate interest rate risk to the best of your abilities. You can never completely eliminate any type of risk unless you just sit on money like under your mattress, but then you're going to be royally screwed for a number of other reasons. And I don't want you to do that. So hope you found this episode immensely valuable. I know I found it valuable going back through this to just further remind myself for my own practice on the value of interest rates and how that can affect people. So I will see you next week. And as always, I'm your host, Christopher A. Paniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Christopher A. Paniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Fixed index annuities are complex long-term investments designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Withdrawals may be subject to surrender penalties or foregoing benefits if withdrawn prior to the contract term. Withdrawals prior to age 59.5 may be subject to a 10% penalty tax in addition to income tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Christopher Paniotu is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning. LPL Financial California Insurance License Number 0518721. LPLIA California Insurance License Number 0B91442.